If you're a small business owner, you already know that getting the capital you need to grow can be one of the biggest hurdles. It can seriously feel like a black box, right? Lenders are making these huge decisions based on numbers you might not even know exist. Well, today we're going to pry open that box and show you exactly what's inside.
So much of it comes down to just one thing: a score. Whether you're trying to land a loan, get a new business credit card, or even just get better terms with a supplier, your entire business's creditworthiness gets boiled down to a single number. But here's the secret, and it's a big one. The score that matters most for your business is probably not the one you're thinking of.
Okay, so what is the real story behind that score? Why is getting access to funding such a major roadblock for so many entrepreneurs? It's a huge issue, especially if your business is new, you're growing fast, and you just don't have a long credit history to show off yet. And we're not talking about a small problem here. The scale of this is massive. A staggering 41% of small and medium businesses in developing countries have financing needs that just aren't being met. Think about that. That is a ton of potential growth just left on the table, all because good businesses can't get the funds they need to thrive.
All right, so to really understand how to get funded, we have to start by clearing up something that trips up a lot of people. And that's the difference between your personal credit and your business's credit. And trust me, it's a way bigger difference than you might think.
Just look at how different these two worlds are. Your personal credit score, the one you probably know, usually runs from 300 to 850, and those reports are private. But for your business, the scores often run on a totally different scale, like 0 to 100. And here's the kicker. Business credit reports are public. Yeah, anyone can pull them, and that information can be legally sold without you even knowing about it.
So, if personal and business scores are so separate, which one do lenders actually look at when you need a loan? Well, for a ton of small business loans, they use a special hybrid score that honestly, most entrepreneurs have never even heard of. It's called the FICO SBS.
The FICO Small Business Scoring Service, or SBSS for short, is a risk score that goes from 0 to 300. It's pretty simple. A higher score means lower risk. Lenders love this thing because it helps them make a quick decision on whether to approve your loan, how much you can borrow, and what your interest rate is going to be.
So, what goes into this super important score? Take a look at this. The single most important factor, the biggest piece of the pie, is the business owner's personal credit data. That's right, your personal financial habits are the biggest part of the puzzle. After that comes your business credit data, the financials you give them, and other info from your application. So, even when you're applying for a business loan, your personal credit history is right there, front and center.
Now, lenders take these scores and group them into risk tiers. Anything below 140 is considered high risk, and that means you're almost certainly going to get rejected. The sweet spot, where things start looking good, is around 165. That's considered low risk. And of course, the higher you climb from there, the better your chances, and the better your terms will be.
And that number, 165, it isn't just a suggestion. For a lot of lenders, it's a hard line in the sand. For the really popular SBA 7A Small Loans Program, it's the minimum score you need to pass the first check. If you're below 165, your application gets flagged for a much tougher manual review. So if you remember one number from this, make it this one. 165 is your target.
Okay, so now that you get the score, let's talk about how you can actually use that knowledge to unlock some capital. We're going to focus on two really powerful options, and which one is right for you depends a lot on that SBSS score.
On one side, you have SBA 7A loans. These are the heavy hitters, right? For major financing, like buying equipment or even another business. And they rely heavily on that SBSS score. On the other side, you have EIN-only business cards. These offer a totally different path forward, one that focuses more on your business's cash flow than your personal history.
Let's dive into that 7A loan for a sec. It's the Small Business Administration's flagship program. Now, the SBA doesn't actually lend you the money themselves. What they do is guarantee a huge chunk of the loan, up to 85% for the bank. This takes a lot of the risk off the bank's shoulders, which makes them way more likely to say yes, as long as you meet that acceptable credit standard, which, you guessed it, is measured by hitting that magic 165 on the SBSS score.
And then you've got EIN-only cards. These are corporate cards where you apply with your business's employer identification number instead of your social security number. The biggest advantage here? No personal guarantee. This is huge. It means you're creating a wall between your business debt and your personal assets.
But because they don't lean on your personal credit, lenders need to see other signs of a healthy business, which is why they often require you to have strong revenue or a good amount of cash in the bank to qualify.
So, knowing all of this, what can you actually do to improve your chances of getting approved, especially for those big SBA loans? Let's get into your actionable game plan.
Here it is, your 5-step checklist. First, and this is the most important one, strengthen your personal credit. It's the biggest part of your SBSS score, so pay down those balances and be on time with everything. Second, start building your business credit by opening accounts with suppliers who report your payments. Third, keep your business financials clean, accurate, and up to date. Fourth, keep your credit utilization low on all your cards, business and personal. And finally, be proactive. Check your reports for errors and jump on them right away.
And looking forward, the way we even measure creditworthiness is already starting to change. This quote from the Alliance for Financial Inclusion really shows that traditional data is just the beginning. Pretty soon, things like your business's utility payments or your e-commerce sales data could all become part of your official credit profile.
And that brings us to a final thought. We're moving toward a world where the day-to-day running of your business could generate all the proof a lender needs. So what if just doing a good job running your business was the actual key to unlocking all the funding you'll ever need? It's a future that might be closer than you think.